Welcome to this explainer. Today, we're unpacking a truly fascinating piece of research, the SRBMPR framework. We're talking about a massive paradigm shift here, completely replacing subjective market analysis with a purely deterministic ledger. We're going to jump straight into the deep end, dissecting the exact rules, the massive data sets, and the rigorous technical audits that make up this totally unique approach.
All right, let's just get right into it. What if you could map market behavior without a single indicator? Seriously, imagine stepping completely away from the noise of moving averages, oscillators, all of it. Because the actual research problem we're looking at today isn't asking, hey, which indicator is going to give me the best signal? Instead, the goal is extracting the exact temporal origin, the exact date and time of every valid cycle from decades of historical behavioral data. No predictions, just cold, hard temporal data. So here's our roadmap for today. First, we'll look at the flaws of subjective backtesting. Then, we'll introduce the SRBMPR framework, map out the deterministic ledger, and define structural cycle breaks. After that, we'll cover the locked parameters and rules, and finally, we'll wrap up with the framework's limitations and honest caveats.
Starting things off with Section 1, the flaws of subjective backtesting.
There is a really stark contrast to point out right away. Traditional analysis, it relies heavily on subjective interpretation. You know the drill. Reading candles live, interpreting open, high, low, closed data, and relying on predictive guesswork, which, let's be honest, is often plagued by optimism bias. Deterministic mapping is completely different. It strictly uses raw data to strip out all human discretion. It doesn't care what a candle looks like. It demands exact dates, exact times, and locked rules applied over massive 20-year data sets of historical market behavior.
Moving on to Section 2, introducing the SRBMPR framework. The definition here is absolutely crucial to grasp. SRBMPR stands for Structural Raw Data Behavior Methodology Price Research. What it actually is a 100% discretionary-free, rules-based process. It crunches through vast amounts of historical data to pinpoint the exact temporal origin of market cycles. It's not giving you a probability score. It's generating a literal, hard schedule of exact start dates and times.
So here is the real game changer. In a live market setting, a trader using this system isn't sitting there hunting for new patterns. You don't need indicators. You don't need to analyze candles or read OHLC data to make a decision. All the heavy lifting was already done by the system on 20 years of historical data. You are simply waiting for a predetermined date and time to show up on the clock. And when that exact moment hits, your predefined entry level applies mechanically. That's it.
That brings us to Section 3, mapping the deterministic ledger.
This brilliantly illustrates exactly what this required output looks like. It is a literal schedule. Cycle 1, year, month, day, hour, minute. Cycle 2, same thing. It's a purely objective ledger of temporal origins dictating your entry. When that exact start date and time arrive, the trade sequence initiates. You don't second guess it, you just follow the ledger.
And another huge point here. Rather than forcing market data into a rigid, simplistic pattern, like a standard 3-2-1 sequence or some isolated fair value gap, this framework preserves the complete, complex behavioral path of the data. It tracks raw, high-low structural relationships to find these temporal origins, meaning the full, actual context of market behavior stays completely intact. All right, Section 4, defining structural cycle breaks. The mechanics behind this are actually quite straightforward, but they are rigidly applied. Step 1, identify the raw high and low structural relationships, say tracking new higher highs in an upward cycle. Step 2, wait for a structural break to the opposite side, like a lower low forming, which officially ends the previous cycle. And finally, Step 3, the most important part. Log the exact origin date and time of that newly started cycle. That timestamp right there becomes your deterministic ledger entry. This extraction process is applied directly to massive exports of raw data, like the 2 years of 15-minute intervals you see here. This data acts purely as the foundational layer for behavior grouping. The engine is scanning millions of data points, not to trade the past, but specifically to generate that deterministic ledger of temporal origins we just looked at. Next up, Section 5, locked parameters and rules. To make this completely reproducible, the system uses frozen parameters. Key among these is a 0.1% pivot threshold and a crucial 0.1% entry lag. This lag places the realistic entry price slightly beyond the origin, completely eliminating look-ahead bias. The system literally cannot cheat by looking into the future. And this is a big one. Every single trade carries a hard structural stop loss of exactly 1%, as mandated by the audit report. The whole premise here is that if you correctly identify these highly specific temporal entries, that 1% stop loss should essentially never be hit on that entry. And honestly, the backtest results are wild. It mathematically produced win rates between 94% and 99% across nested timeframes of Bitcoin to USD. This strongly suggests that when these temporal origins are mapped perfectly, those entries rarely hit that 1% stop loss. But of course, it's absolutely vital we report these figures impartially and look at the broader context, because astronomical numbers like this in quantitative finance demand intense scrutiny.
Which naturally leads us to Section 6, Limitations and Honest Caveats.
The technical audit rightly points out that the tested time frames, which range from 1-minute to 15-minute charts, actually share terminal dates. That means they are nested views of a single continuous price path, rather than completely independent market eras. While part of the data set was out of sample, this overlap means we're observing scale invariance, meaning the same patterns repeating at different zoom levels, but not necessarily proven robustness across totally different market conditions. In fact, the independent technical audit explicitly states, and I quote, "4 nested views of essentially one multi-year BTC path cannot yet be called proven behavioral structure. To truly validate this framework at an institutional grade, it desperately needs testing across completely non-overlapping calendar windows and totally different liquid markets."
Furthermore, the audit highlights that the shortest windows, like those 1-minute charts, are extremely sensitive to exchange taker fees. A theoretical edge could just evaporate in real-world friction. So a crucial next step is required here: paper trading with actual live latency, or forward walk testing on unseen future data. Right now, this is an incredibly impressive historical ledger, but it needs live, out-of-sample friction to be fully verified.
Ultimately, this framework challenges a foundational assumption of market analysis. It asks us a massive question. In a market driven by noise, is structural determinism the only true signal? Could abandoning subjective indicators and candlestick reading entirely in favor of a cold, hard ledger of dates and times extracted from 20 years of data actually be the future of objective quantitative research? It's a pretty provocative thought. Whether it survives live forward walk testing is something the quant community will definitely be watching. Thanks for joining me on this explainer. Keep questioning the data, and we'll catch you next time.